Hi Thrivers, if you're going through a divorce and thinking about keeping the house, this conversation can save you from making a six-figure mistake because there's something almost no one explains clearly. There's divorce math, and then there's mortgage math, and they're not the same thing. And when those two get confused, that's when people agree to settlements that later fall apart. Today I'm going to walk you through the difference, the three biggest mistakes I see, and how to protect yourself before you sign anything. This is education, not legal advice. My goal is clarity, and clarity changes everything. This video is for the mom who wants stability for the kids. It's for the stay-at-home parent wondering if support income will qualify. It's for the high-earning spouse trying to structure a fair buyout. It's for couples mediating and trying to stay amicable and make thoughtful decisions. If real estate is involved in your divorce, this conversation needs to happen at the beginning, not the end. Let's start with divorce math. Divorce math looks like this. What's the home worth? What's the mortgage balance? How much equity is there? How are we dividing it? Who can afford the monthly payment? This math happens inside mediation sessions. It happens in attorney meetings. It happens around kitchen tables late at night when emotions are high and decisions feel urgent. This is negotiation math. This is fairness math. This is emotional math. And sometimes it works beautifully on paper. The spreadsheet balances. The equity division feels fair. The support payments seem manageable. And everyone feels like they've reached a reasonable agreement. And then comes mortgage math. Mortgage math asks completely different questions. Has support income been structured properly to count as qualifying income? Has it been received long enough? Is there at least 36 months of continuance? What does your debt to income ratio look like? What do your tax returns actually show? If you're self-employed, what does your net income qualify you for under underwriting guidelines? Is the equity buyout structured in a way that can actually be financed? Does the settlement language align with what the lender needs to see? The lender is not looking at fairness. The lender is looking at risk. And I cannot tell you how many times someone has said to me, "But I can afford it." And I really, truly believe them. I believe that they can make the payment. But qualifying for a mortgage is not based on belief. It's based on documented, structured, guideline-driven criteria. And those criteria are not flexible just because a divorce agreement says something works. Let me give you a real-life example. I worked with a client who felt strongly about keeping the house for the children. The equity division made sense, the support numbers made sense, the monthly payment felt manageable. Emotionally, it felt like the right decision, but the support had not yet been received long enough to qualify, and the way the agreement was drafted did not meet underwriting guidelines. If she had signed that agreement first and checked later, she would have been forced to sell. Instead, we reviewed everything before it was finalized. Small structural adjustments were made, and the decision was aligned properly with lending guidelines. That's the difference a strategy makes. Now let's talk about the three biggest mistakes I see. Mistake number one, waiting until after the agreement is signed to speak with a divorce mortgage specialist. Once documents are finalized, your flexibility decreases significantly. Before they're finalized, you have options. That window of time matters. Mistake number two, going to your current bank and assuming they understand divorce structure. There are some really incredible mortgage professionals in this country. Some specialize in new construction, some specialize in first-time home buyers, some specialize in credit repair or jumbo loans. Divorce is its own category. When legal documents intersect with underwriting guidelines, that's where things really can fall apart if they're not reviewed carefully. Mistake number three, confusing I can make the payment with I can qualify for the mortgage. Those are two completely different standards. Affordability is personal, qualification is institutional. And if you do not understand the difference, you can make a decision that feels right emotionally but does not survive financially. Here's something I want you to remember. Don't worry about moving slowly. Worry about agreeing to something you don't fully understand. Clarity over speed, structure over emotion, strategy over panic. I don't replace your attorney. I don't replace your mediator. I don't give legal advice. What I do is make sure that the house decision survives underwriting, because the house often drives everything else. It affects your retirement. It affects your monthly cash flow. It affects child support calculations. It affects your long-term financial stability. When you get the house decision right, the rest of the financial picture becomes clearer. And here's the part I say gently and often. You can remain family focused and still be financially strategic. Those two things are not opposites. If you are in the early stages of your divorce and real estate is involved, schedule a free 15-minute clarity session with me. We'll look at your structure before you sign anything, because once it's signed, your flexibility decreases. But before it's signed, that's where strategy lives. If you want a deeper breakdown, download Can I Keep the House guide. It walks you through the exact questions you should be asking before making a decision that impacts your next decade. You do not have to navigate this alone. You can move forward calmly. You can move forward more informed. You can protect your future while staying thoughtful about what matters most. Thank you so much for subscribing and watching. I truly appreciate you being here, and I look forward to connecting with you soon.